The broadcast is now starting. All attendees are in listen-only mode.
Hi, my name is Manoj Abhichandani, and today I'll be presenting on sole purpose of and superfund. We'll just wait for a couple of minutes, and right. Today we're going to talk about the creation of the superfund, why it is created, and why it has to be maintained according to Section 62, the sole purpose of a of the superfund, and what the auditors need to do about these superfunds who breach the sole purpose test, and what action do they need to take, and how do they alert the trustees that there is a breach. Some of you may not know me. I have been in SMSF space for almost 3 decades. I used to run a practice where we were looking after 600 self-managed super funds. I've moved on with that, and uh, we sold the practice. And after that, I was the nominated auditor, and I created online SMSF audit. There are about 600 active auditors. There's some inactive ones, about 900 auditors who are registered to online SMSF audit. About 68,000 funds have been now audited on the system in this year, and I wrote that software, and I highly recommend that if you're an auditor, you should have a look at this software and see whether it is suitable to your needs. Once you log in, you will see that you get 5 superfunds audit credited to your account, and you can try our software without paying a cent and see how it can help you to improve your paperwork. It not only provides all the documentation to assure your professional bodies and the tax office, but also helps you through artificial intelligence to do the financial audit automatically. So it does the dividends calculations, the tax calculation, and the closing prices calculations for all Australian listed shares automatically. So I highly recommend those people who have not used it to have a look at it and see how it's going. We have more than 100 testimonials on the websites from various auditors. You can see what they have to say about the audit software. Right. So let's get into this. We're going to talk about investment rules. What are those rules? What do the trustees have to adhere to? And what the powers are with the ATO, and how far they can go, whether there are any criminal or penalty or civil charges against the trustees. And finally, we'll talk about the auditing issues in auditing self-managed super funds, which may have breached the sole purpose test. So we'll first of all understand what is a sole purpose test, and then I'll slowly move on into the penalty regimes, and then we'll talk about how an auditor needs to audit those funds which may have breached. Now, before I proceed, there's some housekeeping issues. If you cannot hear me, I'm using a very sophisticated mic here. The only choice you have is to look at your panel. There is a phone number there and an access code and a PID. So that's the only other way you can hear me. I cannot improve my microphone here, my audio here. So probably it could be your internet connection, which is not strong enough. So please have a look at your end. The second thing is the handout. What I've done is today's presentation, I've uploaded it as PowerPoint, and some of the viewers the last time told me that they cannot open PowerPoint, or they cannot download PowerPoint. So what I've done is I've uploaded a PDF version as well. So if you want, you can download it. If you have internal in-house training for your staff, feel free to use my slides. We would be recording this webinar, and they will be uploaded on our website in due course of time, say in a week's time or so. Now, we're going to talk about some complicated issues. So if you have any questions in your panel, there is a question box. So just type in your question at the end of the presentation. I'm going to look at your questions and answer them one by one. And those who have not asked a question, it's a good idea to just stick around and see what other people have to say. Now, my presentation will take about 40 to 45 minutes, and then I've allowed 15 minutes for question time, and we should be pretty much done within an hour. But I'm hoping this is a smaller presentation, so I'm hoping it will finish much before 1 hour. Now, this webinar is for educational purposes only. There is no intent from me or from Trustdeed or from the company Deed.com to influence any of you to make any investments in any particular area or share or any block of asset. So I'm hoping that you will get clues from the issues which I'm going to talk about and make your own investigations and make decisions based on all the facts. This webinar is not to influence you in any which way. Right, so let's look at the problem first. The problem is that trustees are setting up super funds and they don't understand the sole purpose test. They think that it's an investment vehicle. A self-managed super fund is just where the money is, and it has to be preserved for a certain age, but they don't fully understand what the sole purpose is, where the investments have to be made. Most financial planners are also not very savvy on SIS rules. I've met quite a few of them. They do understand superannuation rules, but when it comes to self-managed super funds, some of the planners, they have really basic knowledge. So if accountants cannot set up super funds, they are sending their clients to financial planners, and financial planners sometimes are more damaged than any help. Now, within all this, we have seen that about 30,000 new funds have been created since 2007 each year. We have a situation where we have 600,000 super funds. We have more than 1 million trustees. And among all this, accountants are now cannot recommend setup of a super fund unless and until they have a limited license, an AFSL license. They can even have an authority from a license holder, and many accountants have not taken that path. So that's an issue as well. Some accountants are referring their clients to financial planners, and those financial planners have done some fact find for the trustees or the intended trustees, and from that fact find they've written a statement of advice. I've seen some of those statements of advice, and I must say they're very, very basic, and that they don't talk about the sole purpose test much. I've looked at some of the statement of advice coming out from some robo advice platforms where the accountants enter the data and a statement of advice spits out based on some of the factors which they enter into the system. Even those statements of advice are very basic, about 6 to 7 pages, and they talk about other stuff, but they don't warn trustees about the sole purpose test as much as I think that they should. So there is a problem there. And recently, the tax office has been chasing super funds who have not lodged, and about 13,000 funds who have never lodged have the threat of becoming non-compliant. What we've also seen is that younger trustees, the exes, are coming in, the ones who are about 35 to 45 years old. they're setting up the funds, and they're setting up funds with low balances, and that's a bit of a problem. And they're investing in non-traditional investments. Now, when I say non-traditional investments, I'm talking about cryptocurrencies. Some of the assets chosen by these trustees are not very traditional in the sense that they're buying units, townhouses, and houses off the plan, and on the assumptions that when they would be ready, uh, they will be able to seek finance from a lender. So there's a little bit of a gap there, and when these units come up for completion, and because of the slowdown in the industry, it's quite possible that the investments do not stack up, the valuations do not stack up, and they may not have the 30% or 20% required to complete the deal, and banks may reject their loans. So this is a little bit of a problem which is going to occur very soon, and this is mostly in younger trustees situation where they're trying to achieve something which is not possible because they have a low balance. Now, uh, the funds which are being created, some of them are only investing in cryptocurrencies. I was introduced, without taking any names, to a financial planner somewhere in North Sydney. He's apparently creating about 20 funds a day, and this financial planner is issuing a statement of advice and actually recommending bitcoins. And it's a bit of a scary thing because I don't know what you can do with a bitcoin. The second problem I have with the bitcoin is that it cannot be held in trust. The asset is held in the name of the trustees, and that means you'll need some sort of authority, some sort of acknowledgement of trust that these assets are actually held by a trust, but held by the trustee on behalf of a trust. So there is a problem there. I talked about house and land packages. I've seen some deals happening in Townsville, in outskirts of Melbourne and Sydney. So the problem there is that when these houses are ready, because what it is a DA plan which is going to be lodged with the council. So the land is not subdivided; it's a 5-acre lot. The developer wants to cash in the high prices now, so he sells the land and he contracts. Either he's a builder or he introduces a builder. So the buyer actually has two separate contracts. So that's a problem again, because then the land becomes the single acquirable asset and the house becomes a separate asset. So we cannot have two. Um, we cannot have an improvement. We cannot have a borrowing. So there could be some problems there. We have some younger trustees who are trying to buy units, and valuation of units in major cities is likely to go down. Sydney has seen a drop. So let's say if a unit is purchased off the plan 700,000, and when the unit is ready, say in a year's time, the valuation may come out to only $600,000. So the trustees would have to not only come up with 30% of 600,000, but they would have to come up with the balance between 700 and 600, the 100,000 extra, and the fund may not have that balance. In that case, it's quite possible that the developer would probably not return the 10% deposit because the trustees would have breached the contract, and it's quite likely that super funds may lose the whole deposit, the 5% or 10% or whatever they have paid to the developer. So the problems which are going to happen, and this is motivated by quite a few property spukers who have the knowledge and they have linked themselves with financial planners to tie up the loose ends, but it's the ultimate trustee who is left a little bit in the lurch, and unfortunately they haven't had a second opinion from financial planner or another financial planner or their accountants. So there's a little bit of a gap on advice there. Now, there's still schemes going around for early access of preserved benefits. We all know that once monies are contributed, the access is under limited circumstances. So those limited circumstances are not very well explained to the trustees. And we still see funds setting up where the rollover at the beginning is lower than $200,000, and I think that 200,000 is also a very low figure. I think it should be close to 400 to $500,000. And we see funds which are being created for less than $100,000. In fact, if you look at the ATO statistics, you will see that almost 4% of funds have less than 100,000 in there. Now, that's very bad because one, the trustees are not able to diversify their investments, and second, they will lose their interest in managing the asset because of the low value in there. So I think some of the trustees either are not qualified or they haven't got the legal and the financial opinion, an independent financial opinion on how these investments must be made in a self-managed super fund. Now, let's have a look at the legislation. What does sole purpose test tells us? You have to look at section 62. It has two limbs. One is a core purpose, why a super fund should be created and how it should be maintained. Um, the section 62 talks about the members' retirement. That means the monies have to be kept in the fund. The trustees must maintain solely, the important word here is solely, for the retirement of the member unless he reaches 65, so he could be still working, or the preservation age, whichever happens first, which we know for this year is 57, and on 1st of July it'll be 58, or till the member's death for the dependents of the member or the legal personal representative of the member. That is, the monies can be paid out to people who look after his will, should the member decide that, and nominates the legal personal representative to receive his superannuation interests after the member's death. Now, the ancillary purposes are similar to the core purposes. Um, so we must have at least one core purpose and one or more ancillary purpose. So we could have termination of employment in case the member falls ill, or after the member's death, the money going to the dependents or going to the LPR, or any other reason why the regulator should hand over the money to the member before the retirement age. Now, in 2008, there was a ruling, 2008/2, and that ruling talked about in detail the meaning of sole purpose, because there were quite a few investments which trustees were getting involved with, and they were not directly 100%, you could say, up, uh, tuned towards the sole purpose test. So what the tax office said was that we can't just look at one item, so we have to survey all the events and circumstances relating to the super fund and then make a decision whether that investment is for sole purpose or not. And that full survey will give a objective assessment of whether the super fund is maintained for the sole purpose or not. So it was then considered in 2008 that there could be many reasons for a particular investment. So we just cannot limit that the investment made by the trustee is or is not for those purposes which I mentioned to you earlier. Now, one thing in clause number 7 in SMSFR 2008/2, they talked about that this has to be a strict standard of compliance, and it requires an exclusivity. So we just can't say that there could be lower reasons than those mentioned in section 62. So we must have those reasons, but we can also look at the surrounding reasons uh, in in determining whether a sole purpose exists or it does not exist. Now, we must look at the principal purpose and we must look at the dominant purpose along with whatever the investment has been made, and then come to a conclusion whether that investment is for sole purpose or not. And the ruling actually talked about uh, incidental or remote or insignificant benefits which the member could obtain, and in those circumstances, the tax office would consider those investments to not to be breaching to the sole purpose test. But there were some breaches where they thought that there would be a problem, is where the trustees were looking for some other benefit, not the investment itself. And I'm going to talk about a few examples as well. And they said that the trustees, while they're making investment decisions, we have to look at what was really influencing them. Was it the benefits which they were going to get today, or was it for benefits which they're going to get at the time of retirement? So the thing to note was that if they were going to get today benefits, was it going to cost the fund anything? So whether the fund is going to lose on the long-term basis for today benefits. So those were the criterias to look at to make a decision whether the investment is for the sole purpose or it is not. But there could be some factors which could be incidental or very remote or of very small value, and it's inherent in that investment. Let's say Coles came up with some shares, and they said that if you were a shareholder, you would get 5% discount. So that was unavoidable because the investment was supposed to be in Coles, uh, but but because you got that discount, the reason for purchase of those shares were not to get the discount, but because it was unavoidable, that did not defeat the purpose. So that means that the investment passed that test and it would not breach the sole purpose test. And some of the benefits are very remote and it may or may not happen, and it was likelihood that a trustee may not be in that situation to receive a benefit in any investments. And I'm going to talk about some examples as well. And there were some benefits which was at arm's length. I mean, that were really not really a benefit. They were considered to be benefit, but they were not really a huge benefit. They were like a very small value, and they were so insignificant that the sole purpose test was still considered to be maintained. So what the tax office and what the ruling the tax office was trying to say, that if you followed your investment strategy and if you considered all the aspects of any investment, then if you did get something which you did not expect, or it was so remote or it was so insignificant, we won't worry too much about those benefits which were received today at the time of making an investment. Now the ruling talks about a few examples, and then you'll get the gist of it by looking at those examples, and you'll see what the intent was and what they didn't want it to penalize those people who were genuinely making an honest investment decision. So the first example talks about an investment in a pooled holiday property. So this was an investment made in a company, and that company owned the whole building, and the trustees visited that holiday property and they paid market rate. And because you were an investor, you got a free upgrade if it was available. So you did not own any unit as such, but there were maybe two or three different types of properties which you could live in. So if you were a shareholder, you could get the upgrade at the lower price, but only if it was available. And the trustee actually did not seek this benefit. He did not make the investment just because of this benefit, because it was very remote that when he was visiting, an upgrade was available and it was vacant. That unit with higher value was available, so he would pay a lower figure, and the higher property was available. And also, the upgrade did not influence the investment decision. That was independent. So he never thought that he would get the upgrade each time when he visited that property. And this was an inherent feature. So this is what the promoter was selling, that if you did buy or if you did make an investment of X amount of dollars, you will get an upgrade. So this was unavoidable as far as the trustee is concerned. Now, in this example, we've looked at a pooled holiday property, but this concept also is possible in an individual home or a holiday unit. So let's say the house needs repairs and the trustee stays in the house to get a significant repairs and pays normal rates. So under these conditions also, the ruling says that because he has to stay there and it's a significant repair, and although it's the property belongs to a super fund, the intention of the trustee is not to stay there, but to actually get the repair work done. And if you look at the last example on the screen, the business travel, so it was not a holiday travel. And if the super fund owned a unit and if the unit was empty, the trustee, if he stays there and he pays the normal rent to the management, it would be considered as if it's incidental. So it's not like the intention of the purchase, because it's a business purchase, it's not for holiday travel. In any case, the trustees would have stayed somewhere else and paid the same amount of money. So as you can see that there is no loss actually to the super fund by making these investments. So if you look at the example above, in the in the in the in the ruling, it says that is the trustee looking for a benefit? In none of the examples they were looking for a benefit. And was the decision made because of the benefit? That's also true, that the when the investments were made, the trustees were not looking at it. And did it cost the fund? In none of these cases, it costed the fund, because the fund always received the correct amount of income from those investments. Now let's have a look at the negative side of it. So let's have a look at another example where superfund trustees invest in a company that owns a block of holiday apartments. The members go to this destination every year. So their intention is to get free accommodation. And at the time of buying, the trustee were negotiating to stay in their unit for free. And it's not a standard feature. So they negotiated, they want a special deal. And because they want this special deal, the super fund gets less income for this free stay. So you can see that there is a current day benefit. So if an investment is made and the benefit is apparent and it is negotiated, the intention is for current day benefit instead of just a normal investment. So there is a problem. Other examples in the ruling are like if a painting is purchased and it's displayed in the trustee's home or the office, even if the trustees pay rent to the super fund, but because the painting is being displayed, the trustee is getting enjoyment out of uh, that asset of the super fund currently. So in today, instead of being preserved, then there is a problem. And uh, the ruling talks about that it's not that you are in accumulation phase and retirement phase, because if you're in a retirement phase, sometimes it's considered it's your money and you can access it anyway. So the ruling does not defer members or trustees who are retired. Now, sometimes what happens is that you own a property, the super fund owns a property, and it spends some money. The super fund has expenses of travel and accommodation for trustees to go and have a look at that property, whether it's doing fine or not. So it incurs certain costs. So that's also considered as incorrect because you are intentionally buying. Let's say if I lived in Sydney and if I bought a unit in Cairns and my super fund paid for my travel and my stay in Cairns so that I could inspect my property. So the ruling considers that also not to be right because there are ancillary benefits which I will receive by buying this property in Cairns. Now, sometimes you will notice that some super funds, if you're an auditor, has a related party loan and the interest being paid is too high. So that again is also not considered to comply with the sole purpose test because it is the it is being considered as if the money is being withdrawn out of the super fund because you're paying a higher rate of interest. Now, there are certain investments which are called like in collectibles and personal use assets. Um, the whole list is available in section 62A, and there are things like artwork, jewelry, antiques, coins, memorabilia. All of these things, there are some strict rules which apply to it. First thing is that these assets must not be leased to a related party. Second is that they should not be stored at a private residence of a related party of the fund. So that means they must be stored in an appropriate place. And within 7 days, you have to insure these assets. And you should not use those assets. You as a trustee or any related party should not use those assets. And if you are buying it from the super fund or if you're selling it to the super fund, then you need an independent valuation. Now, if the super fund owned these assets on 30th June 2011, they had up to 1st of July 2016 to not follow these rules, but now they have to follow all these rules. So if you're an auditor, if you see any of these assets in a super fund, you have to be a bit more vigilant and see whether these investments are for the sole purpose for those retirement benefits and death benefits as we discussed in section 62 above. Now there's some court cases. So this one I've just picked up too. There's one case with Graham Family Superannuation Fund, and what they did was they purchased a property. It was a rural property, and Graham's husband and wife, they were both teachers, and the husband was managing the fund, and the wife did not know much of what was happening. The son was late in paying rent. The rent being charged was actually market rent, and when the matter went to court, there was about 60,000 outstanding rent, which the son had not paid. The fund also purchased about $240,000 worth of various items for the farm for the son, and just given it to him, and they were shown as a loan. Uh, the auditor had lodged a contravention report, and that's how the tax office got onto it. So when it went into court, the first thing which the Grahams did was that they repaid the loan. That was a positive thing. So when it was heard in court, there was no loan on that date. The rent was also repaid. Whatever outstanding rent was, that was also paid by the son or maybe the trustees, but it was deposited into the fund. So the court had to decide whether or not the sole purpose test was met or not. And what the court looked at is that it was an asset which was rented to a related party, but they looked at the market rate and they thought that the purpose, the intention was to lease and get uh, correct benefit, uh, the market rate. So there was an arm's length dealing, although with a related party, but there was an arm's length dealing. So they thought that the sole purpose test was more or less okay, but because the investment did not really breach, because uh, the intention was to receive the highest income possible, and although it was leased to a son, so the fund was receiving the correct, the son was paying the correct amount of rent. So then they looked into other areas of the CIS Act, and they said, okay, if Section 62, the sole purpose test, has been met, what about Section 71? Because this was a farm house and it's being leased to a related party, and they thought that Section 71 was breached. So the fund was not made non-compliant, although there were 90 odd breaches, and these breaches were mostly buying assets for the farm, buying assets for themselves from the fund, and the reason I think the fund was not made non-compliant was because the trustees were very cooperative. They understood that there's a mistake which has happened, and they contributed to all the wrong things which were found by the auditor. Now, one thing interesting was that there were two trustees, husband and wife, and because the husband had a dominant role, he was penalized 30,000 and the wife was penalized 10,000. Now, this case was a little bit older, but now the rules have changed. If it was to be tried again, the penalties would be very close to $200,000. So this case is something which we should not take lightly, because one thing is very clear, that it's not only the Section 62, it could be a combination of other sections which we have to be very careful about. And as far as auditors are concerned, we must ensure that this was a farmhouse. It was considered as a commercial property, but there was no farming happening, so it was considered as a residential property instead of a farmhouse. So it was not considered as being a business real property as such. The second thing which we need to note is the role of each trustee. And like I said, that if it was tried now, it would be, the penalties would be equal, and it would be much higher than what they were at that time. Now, there's a recent case. This is a very interesting case. Aussie Golfer Pty Limited. It's a trustee against the tax office, and here this was a one-member fund, and they invested $28,000 initially into a widely held fund. So Domacom fund. It's a MIS. A lot of people invest in it. There was a second tranche of investment made when a property was found. So, in fact, this fund was an employee of Domacom. In normal circumstances, it would have not gone to court, but they wanted to test whether their product is foolproof or not. So there was a second tranche of investment made into Domacom fund. About $104,000 was invested, and then a sub fund was created. What Domacom does is, for every investment it makes a separate sub fund, so money moves from the major fund into a sub fund. The member's mother then contributed into the sub fund. She subscribed to some of the units, and the member's sister also contributed 25%. So 25% came from the super fund, and 50% came from the mother, and the remainder 25% came from the member's sister. So this sub fund ended up owning a property, and the trustee of the sub fund was one of the entities which was controlled by Domacom. So uh, the trustee of this sub fund had a lease with the Student Housing Authority. This was somewhere in Melbourne, in Burwood. And later on, there was a sublease by the Student Housing Authority to the member's daughter. Now, if you look at this situation, you will see that the fund which was in question for did not actually invest in the sub fund who was the legal owner of the property. It actually invested in a widely held trust, and that widely held trust invested its money into that sub fund. So the ATO thought that the lease to the daughter is a breach of the sole purpose test, or it's an investment which is an in-house investment, because somehow that sub fund is a related trust, because all the units of those 25% were held by Domacom. So just going back there, so um, according to the tax office, this fund becomes a related fund of the super fund, and basically what they're doing is they're unmasking this fund and seeing where the money is being invested. So um, when the tax office thought that uh, the money is being directed, it was quite possible that there could be another fund, uh, uh, which was another sub fund which was created by Domacom. Domacom creates these sub funds all the time, so they could have like 50 or 60 other funds. So it could be challenged that this money was actually invested elsewhere, but they also decided to invest the same amount into this fund as well. So the tax office believed that it was because of this investment which the super fund made into Domacom is the reason why Domacom invested in this sub fund. So there was a second layer which they opened up. And as far as the super fund trustee is concerned, the investment is in Domacom and not in the sub fund. So this was his argument that the investment is in a fund which is not a related fund. Anyhow, the court decided that there's a breach of Section 62, and the sole purpose test is an issue because it's providing present day benefits to the member's daughter. Now, if you're an auditor, just think, the last fund you audited and it was a residential property. Did you check the name of the tenant on the residential property? Because sometimes look at the lease agreement. Um, uh, we just look at the rent coming in, and sometimes if there is any mischief, usually the trustee will involve um, in a real estate agent, so that if there is a related party staying at the property, then Because the rent is coming in from a real estate agent, it could be camouflaged as if it's a genuine tenant instead of a related party tenant. Now, what if the lease is in a relative's name? What would you do? I mean, uh, obviously, then it becomes an in-house asset because it's Section 71. You will not lease a property to a related party, and then you test it under the 5% rule whether that investment is less than 5% of the total assets of the super fund. And if it is, then the super fund gets 1 year to Section 82 of SIS Act, gets 1 year to actually dismantle that situation, and there's no coming back. So you cannot do anything much. You have to actually sell that asset, and it cannot be relieved. So you cannot get the tenant out, because once that fault happens, once the breach happens, once you discover that breach, that a relative is living in that property, they get 1 year to actually sell that property. It's not that they can get rid of the tenant who's a relative and then everything is fine. That's not allowed anymore. What has to happen is Section 82 will come in, and that Section 82 will say that you get the 12 months from that period of the breach to actually get rid of the property and get rid of that asset so that it no longer remains an in-house asset of the super fund. Now, there could be another breach, and if a super fund conducts a business, as we see that these are investments, and sometimes an investment can be in a business. First of all, let's define what is a business. Can uh, the business of a super fund be buying and selling shares? And we see that there are some trustees who are very active, and they're buying almost on daily basis and selling shares on daily basis, and they're just playing with the margin. So can this be considered as a business? And if you take a step backwards, if there is a buy and hold strategy in place, so the trustees have bought Westpac shares, and what is Westpac doing? Westpac is also conducting a business. So we must be very careful in thinking that what is a business? I mean, can business be buying a block of land every year, subdividing the land and building a duplex and selling it, all in the name of the super fund? And why would you do that in the name of the super fund? The reason why you would do it in the name of the super fund is because your tax would be much lower, will be 15% if you are in accumulation, and it could be zero if you're in pension fund and below the 1.6 million. But there could be some other types of businesses as well. Can a super fund operate a news agency? Can it invest in a company and that company owns a news agency? Or can a super fund invest in a accountancy practice, a company which runs an accountancy practice, a company which runs a cafe? Well, the good news is that there's nowhere in the legislation, as long as the trustee allows it, a super fund can conduct a business. But there are instances where the tax office and APRA have released information about conducting businesses and risks associated with conducting a business. Risk associated in employing the trustees, because then you could be giving them more salary or you could be giving them less salary, so there could be arm's length issues. So what you pay to related parties could be an issue, and there could be some risks which the trustees may take, and it's quite possible that you may take some loan. You might have sundry creditors in that business, so there could be some owing, some borrowings in that super fund, and then we'll have an issue with Section 67 of the fund, Section 67 of the SIS Act. So, although conducting a business by itself is not prohibited, the only condition being that the trustee should allow the trustees to conduct a business. But there are certain things which you do with the business which actually put you into trouble. I've seen some accountancy practices being run by super funds. These are multi-level practices. I've seen some financial planning firms being owned by self-managed super funds. So again, they are multi-principal practices. There are many principles. There are many. It's a larger size of a business which is being run. What is very interesting is that till now we had criminal charges. Sorry, till now we had civil charges and penalties. Uh, this is the first case, the Kasangos case, where uh, there was a jail term awarded to the trustee, and what he was doing was that he set up a fund which was called the Kasango Superannuation Fund, and he was adding members. So he was involved in unlicensed financial services. He was influencing people to join um to join his fund. And once they joined the fund, in fact, 4 million was rolled over into his fund by various um, uh, rollover entities, various public offer funds. There were 192 people who joined his fund. So he would make them join the fund, and he'll earn some commission out of it. And after earning the commission, he would actually give them the money. So the intention here, the judge found, was malicious. He was intentionally engaged in uh, helping people withdraw their benefits and distributing those monies out. It was pretty planned up business. He had agents, even agents got commission. So it was an intentional scheme where it was the intention was when these people became members, they would withdraw. They were promised a withdrawal amount before they actually joined the fund based on the amount which was going to be rolled over into the fund. Kasango got $600,000, for his efforts. Now, there are two things uh, relating to this case, and they're very interesting. First thing is that what happened to those 192 people? Did the tax office go to them and ask them for depositing their monies back into the fund? I looked everywhere and I just couldn't find it, because once the money was paid, because when they were paid out, they were members of the fund, so they were actually breaching the legislations themselves. So did the tax office go after those 192 people? Quite frankly, I don't know the answer of that, and I looked everywhere. I looked at the case itself, and I thought that I'll find something, but it's absolutely uh, nothing. It stops at when Etan Kasango was jailed, and that was the end of it. So they wanted to make sure, the tax office wanted to make sure that they stop him. But all those people who got the money got scot free. The second thing, which is very interesting about this case, in fact, I was talking to one of my staff members, and and one of the remarks made by one of the staff members was very interesting. And they said, and this person said, "Did I know of anybody who's still doing this?" And I asked him why, and he said, "I wouldn't mind." That young person, my staff member, said, "I wouldn't mind paying a commission and getting my hands to my money now." And what is interesting here is, um, there are rules set up, and I understand there are rules, uh, but there should be a reason behind putting a rule into place. So this young person in my office, the reason why he wanted the money, because he wanted to buy a property as his principal place of residence. He's a new migrant into the country, and he's worked 7 years, him and his wife, and they have not been able to buy a property. And he was talking to me what property prices were in 2011 and 12, and had he had the money then, he would have been able to buy a property, and that property is almost double now in Sydney. Um, I'm going to just move away from his situation to my own father's situation, and uh, when he built his principal place of residence back in New Delhi in India. The Indian laws actually allowed him to access his provident fund, that's what they are called in India, and buy a piece of land. And it's because of that that he still has a roof over his head, because he was able to actually access his provident fund and purchase a property for himself and his family. It's very interesting. My brother still lives there, my father still lives there, and it's our family home, and we still got it. Now, in contrast to all this, let's have a look at what the new legislation is talking about. We know that the downsizer legislation has been legislated, has come into form, and from 1st of July, anybody who's over 65 is able to contribute $300,000 into a self-managed super fund. And there are certain, terms and conditions which he has to meet. Now, on the same day, there was another legislation passed that a young person, whatever they have contributed, cannot withdraw more than $70,000 to purchase their principal place of residence. Now, I find this to be a little bit not fair, because you can sell a property and contribute 300,000, but you cannot withdraw 300,000 to buy your first principal place of residence. So, as far as my employees' comment was concerned, uh, do I need, do I know another Kasango? It's probably something which you need to think about. You need to say, uh, is there any need for a new migrant, a new university graduate, someone who does not own a property, does not own a principal place of residence? Should we or should we not allow this person to actually buy a principal place of residence and access superannuation money? So we do wrong things. The reason why we do wrong things is because in our mind we feel that it's unfair to us. So Kusongo might have thought that this is unfair to him, and but those 192 people did not think like that, and they were happy to somehow pay 600,000 to a person who could actually give them their own money somehow illegally, though. And I don't support that, because it was done against the law. What I support is a change in legislation where young people are allowed to actually take a loan, or get some sort of a 10% or a 20% deposit, if possible, from their provident funds, their superannuation funds, so that we don't have to go to people like Kosongo and conduct a criminal offense. So my idea is more to allow these kind of withdrawals than to conduct in mischievous activity. All of us are allowed to express our opinion, and if you agree with me, perhaps a letter to the minister or to the tax office would be appropriate. And this probably is more applicable to some of you, because I see my kids coming up now. They both are in uni and they're about to get jobs, and In Sydney, property values are about $1 million. They need $200,000 for a deposit, and they need very high income because otherwise they won't pass the tests to get a loan. So they have no hope. And I recently read a nurse who worked in Sydney had to live about 300 kilometers past Gosford, somewhere in Maitlands. That's the closest property she could afford, and that property was worth 460 odd $1,000. So someone earning about $60,000 can only afford a property which is like 300 kilometers away. So that's an issue which is very close to my heart, and I think there is some possibility that there will be some change in heart from the politics side of accessing money for young people to buy principal place of residence. Um, as far as the auditor's role, I would say that you have to be a little bit more vigilant. You have to identify investments that offer pre-retirement benefits, and that could be um, very difficult because if you have a fund which has property, you need to find out who the tenant is. A declaration probably would be a good idea because the person could have any surname. There could be any name on the lease, and anybody, a friend or whoever. But it's possible that the children would be is staying there. Now again, I'm just going back to the Kosongo's rule. So if rules are strict, the trustees would go around that rule and try to do something. And as far as the auditor is concerned, they're supposed to follow the law, and they have to do what is right, and that's what they are supposed to do. Again, you'll have to see whether any investment is made in such a fashion or for a reason that someone related to the fund is actually benefiting, and maybe it's not the trustees who's benefiting. And then, if an investment is made for a detriment of the fund, that means the fund is losing out because of that investment. Now, this could be opening a can of worms. I mean, I've seen funds which have got $1 million sitting in a fixed deposit of 2%. Now, I feel that's a detriment to the fund because the consumer price index is probably, the CPI is probably 3%. So the fund is actually losing money. And I think that investment could be somewhere else in a growth asset instead of a losing asset. So I don't know where your role will stop. What whether you should comment if large amounts of money are sitting in a fixed deposit or in a non-performing assets. And it could be possible that a significant proportion of the asset is in a non-performing asset. So I'm not sure whether you would go into that depth and actually telling the trustee where they should invest. In. But if the investments is in bitcoins, and if the investment, I mean, Bitcoin again, I talked about my staff member. He actually ended up setting up a fund, and he wants his money to grow very quickly, and he's invested in Bitcoin, and his fund has got less than $15,000 in it. I don't know how many bitcoins he will buy out of that, but there is a self-managed super fund out there with $15,000 in there, and that was his decision. And he did not use an accountant. He went online and he set up the fund. It was a trustee's decision. So you know, it's highly detrimental. So I don't know who's going to audit the fund. I'm going to refuse if it's offered to me that position, but as an auditor's position. But you will see some funds who do a lot of trading in foreign exchange, and they do trading in um, all those underlying assets of a share, like futures and things like that. They're very risky. A self-managed super fund or any super fund is supposed to be a long-term investments for a good rate of return. as long as the underlying asset is strong, you don't want to lose the capital here. So, although some auditors do not go into that role because they feel that's not what they're employed to do. Now, investigations by an auditor could extend into is every home purchased by superfund leased to a related party. Now, this is something you will see that you haven't gone that far. So maybe you have to take that one more step and dig a little bit more deeper to find out who the tenant is. I'm talking about residential property. As far as business real property, there are other concerns. That is whether the market rent is being paid by the related party or not. And if there's an agent involved, does not mean that there's no related party. And if there's outstanding rent or lower than market rent, then there is a problem. And in the last line, of course, if there is smoke, there is fire. So look at all those issues and see whether the sole purpose is being met or not. That's it, folks. I'm just looking at the question screen. Um, uh, I can